Business models of private wealth management service providers. Private wealth management, PWM, encompasses a broad spectrum of institutions, ranging from large universal banks and private banks to independent advisors, boutique firms, registered investment advisors, and family offices. These organizations tailor services according to client wealth levels and complexity of needs. Clients are generally segmented into retail, affluent, high net worth, HNW, and ultra-high net worth, UHNW categories, with increasingly customized services provided as wealth and complexity rise. Retail clients typically use standardized investment products, whereas HNW and UHNW clients require sophisticated planning, specialized investment opportunities, and integrated advisory services. Segment-based strategies enable firms to allocate resources efficiently while maximizing client satisfaction and profitability. The competitive landscape of private wealth management is shaped by varying business models and strategic positioning. Some firms pursue a cost leadership approach, leveraging scale, technology, and standardized services to attract large numbers of clients at competitive prices. Others adopt differentiation strategies by offering exclusive investment solutions, advanced planning capabilities, and personalized advisory relationships. Boutique firms often focus on niche markets or specific client segments, emphasizing highly customized service and specialized expertise. Competition is intensified by technological innovation, greater client sophistication, and increasing expectations regarding transparency and service quality. As a result, firms must continuously refine their value propositions and balance efficiency with personalization to remain competitive in evolving global wealth markets. A defining feature of PWM is the breadth of services offered across clients' financial lives. Core offerings typically include deposit management, portfolio management, financial planning, retirement planning, estate planning, trust services, insurance solutions, and lending products. While some services are delivered internally, others are outsourced to specialized providers due to regulatory requirements or technical expertise. As clients move from affluent to UHNW categories, the need for comprehensive and integrated solutions increases substantially. UHNW clients often possess diverse holdings across businesses, private investments, real estate, and multiple jurisdictions, requiring coordinated advice from numerous specialists. Consequently, service providers increasingly emphasize holistic wealth management rather than isolated investment management. Fee, revenue, and compensation structures. Private wealth management firms traditionally generate higher fees than retail financial institutions because of the personalized nature of services provided. Revenue streams can be categorized as recurring or non-recurring. Recurring revenues arise from portfolio management, custody services, tax planning, and ongoing advisory relationships, while non-recurring revenues originate from one-time events such as estate settlements, divorce-related planning, or customized projects. Revenue may also be fixed, including periodic service fees, or variable, such as transaction-based commissions and assets under management, AUM fees. Regardless of structure, firms are increasingly required to disclose fees transparently and provide clients with comprehensive fee schedules at the outset of relationships and whenever fee arrangements change. The AUM fee model remains one of the most common compensation approaches in the industry. Under this structure, advisory fees rise and fall with the value of client assets, aligning advisor compensation with portfolio growth. However, this model introduces procyclicality because revenues decline during market downturns. Other compensation methods include transaction-based commissions, lending spreads, service-based retainers, and maintenance fees. While these structures can support profitability, they may also create conflicts of interest. Practices such as churning, payment for order flow, and retrocessions can incentivize advisors to prioritize personal compensation over client outcomes. Consequently, regulators increasingly emphasize transparency, suitability, and client-centered advisory practices throughout the wealth management industry. Wealth management firms face substantial pressures on margins and profitability. Technological advancements such as robo-advisors, online trading platforms, and automated financial planning tools have reduced barriers to entry and lowered costs for investors. Simultaneously, clients increasingly expect access to environmental, social, and governance (ESG) considerations within advisory services, creating additional operational costs. Regulatory reforms, including measures designed to eliminate hidden commissions and improve fee transparency, have further altered industry economics. To grow revenues, firms generally pursue four approaches: benefiting from asset appreciation, increasing fee levels through differentiated services, attracting new clients, and retaining existing clients. Key performance indicators include net new money, NNM, and net new business volume, NNBV, which measure business growth effectiveness. Support for private wealth managers and clients, and regulatory issues. Private wealth managers rarely operate alone when serving complex clients. They rely on extensive networks of specialists, including tax advisors, attorneys, accountants, insurance professionals, custodians, philanthropic advisors, commercial bankers, and investment bankers. The importance of specialist support increases significantly for UHNW clients because of their complex legal structures, business ownership interests, international holdings, and succession planning needs. Family offices often serve as coordinating entities that integrate these diverse services under a unified governance framework. Wealth managers themselves act not only as investment advisors but also as educators, mediators, negotiators, and trusted counselors who help clients navigate both financial and non-financial challenges across generations. Regulatory and compliance considerations have become increasingly important within the PWM industry following major financial scandals and market failures. Events such as the global financial crisis, the Madoff Ponzi scheme, the Panama Papers, and the 1MDB scandal highlighted weaknesses in transparency, governance, and oversight. Consequently, regulators have strengthened anti-money laundering (AML) requirements, enhanced beneficial ownership disclosures, increased scrutiny of politically exposed persons (PEPs), and promoted international information sharing frameworks. Organizations such as IOSCO and FATF play critical roles in establishing standards that support market integrity, investor protection, and the prevention of financial crime. Wealth managers must therefore maintain robust compliance programs while balancing regulatory obligations with client service objectives. Ethical conduct and fiduciary responsibility remain central to successful wealth management. Regulatory frameworks such as MiFID II, HFMD, UCITS, SEC disclosure requirements, and global AML standards reinforce transparency, suitability, and investor protection. Complementing these legal requirements are professional standards such as the CFA Institute Code and Standards, the Asset Manager Code, AMC, and the Global Investment Performance Standards, GPS. Although some of these frameworks are voluntary, adherence generally promotes consistency with global regulatory expectations and enhances client trust. In an environment characterized by increasing complexity, cross-border activity, and evolving client demands, firms that combine strong governance, ethical behavior, transparent compensation, and multidisciplinary expertise are best positioned for long-term success.